The U.S. Fed has lifted its key interest rate to the 4.75% to 5% range. And Wednesday's decision marks the 9th rate rise in a row. Why can't the Fed end interest rate hikes despite the recent banking turmoil? For more on this, let's turn to Professor Joshua William Mason from John Jay College. Welcome to the program.
Thank you for having me.
Thanks for joining us. So the Fed went ahead with a quarter-point rate hike despite the recent failures in the banking system. Now, walk us through the reasons behind the bold move.
Well, the basic notion here is that by raising the interest rate that the Fed sets for banks to lend to each other, that makes credit less available for the rest of the economy. And the hope is that over time that will reduce spending on goods in short supply and also reduce employment, compelling workers to accept lower wages, and those lower wages eventually should get passed through to prices. That's the theory. One problem here is that many of the price increases that have been driving recent inflation are not very linked to the kind of credit conditions that the Fed can influence. But another problem, as we're seeing now, is that monetary policy like this has to be carried out through the financial system, and it may put a lot of stress on the financial system before it actually has any impact on the real economy, and that puts the Fed in a very difficult position.
Right, I'm sure it was a challenging decision for the Fed to raise the interest rate this time. Now, then the question is, how effective will the rate hike be for taming the recent financial turmoil?
I don't think the rate hike in itself is going to help at all with the financial turmoil. I think other actions that have been taken, obviously the rescue of the depositors in these banks and the Fed's sort of promise to continue rescuing them, I think clearly there's been some failure to coordinate a message between the Fed and the White House, where you have Chairman Powell saying that deposits are safe and Secretary Yellen saying that there will be no guarantee for large deposits. There's some kind of inconsistency in the messaging there. But I think in principle, those sorts of actions can prevent further banking turmoil. The problem from the Fed's point of view is that offering additional support for the banks, additional emergency lending to the banks, as they've been doing, may sort of undermine their efforts to tighten financial conditions through these rate hikes.
Now, on to the inflation. Inflation in the U.S. in February continued its slow but gradual cooling trend. Now, how long will the Fed's fight against inflation continue, do you think? Is it nearing an end in any way?
I think so. I think that they're going to find that the stresses that rapid rate increases impose on the financial system are just intolerable. And even if they try to continue raising interest rates, they're going to be forced to do more lending through the discount window, through emergency facilities like the one that they created in the wake of the Silicon Valley bank failure, that it's basically going to offset whatever they're doing with these rate hikes. I think they've sort of reached the limit of what they can do without inflicting too much pain on the financial system. I'm not sure that, honestly, what they're doing now is having that much of an impact on inflation one way or another. A lot of the factors driving inflation, in my view, are really outside of the Fed's control.
Then there are some forecasts that say that the Fed's inflation fight will be over when it decides to actually freeze a rate. Are you on the same page?
I think that's true. Certainly, if you look at what participants in financial markets seem to expect, they expect an end to rate hikes quite soon, and probably a shift back towards cutting rates. So I think it's likely that we're seeing the end of this cycle of rate hikes. Hopefully, we're also seeing an end to inflation. But I think to some extent the Fed's hands are tied, even if inflation remains high. I don't think they're going to be able to continue raising rates in the way that they have been.
Well, I mentioned earlier, inflation in February continued its slow but gradual cooling down. What's your forecast on the March in terms of U.S. economy?
Well, unfortunately, there are some factors that could pull measured inflation back up. There's reason to think used car prices, which were a big factor in inflation in the first surge in inflation a year and a half ago, used car prices could well start going up again. There's a real shortage. It looks like developing there. And because of the lags in the way we measure rental prices in the CPI, it's very likely that rents, which are a very large part of the price index, are going to keep rising for a while. So I would not be surprised to see measured inflation go back up in the next month or two.
Before we let you go, Professor Mason, so the Fed Chief Jerome Powell mentioned that the Fed will not, there will be no lowering interest rates. Why? What do you think the reasons are behind the comment?
I think that honestly, he feels that they were too slow to respond to inflation the first time. You know, Powell initially was very outspoken for a Fed chair about the importance of maintaining full employment, about the importance of strong wage growth, about the Fed's responsibility for the distribution of income and helping those at the bottom of the ladder who are really the ones who are affected by high unemployment. And I think perhaps in some sense he feels now he has more to prove as an inflation fighter because of that position he took earlier, and he needs to be even more focused sort of single-mindedly on bringing inflation down than he otherwise might have been.
Right. All right, Professor Mason, thank you so much for your insight this morning.
Thank you.